My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Kramer. Welcome to Mad Money. Welcome to Kramerica. Other people make friends. I'm just trying to make a little money. My job is not just to entertain, but to educate, to teach you, put it all in context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. 8 years ago, in a moment gripped by political fever, I put a button on my soundboard that said, Trump stock, Trump stock. After this weekend's events, it looks like I have to bring it back because of the extraordinary moves we saw in so many stocks today. A day where the Dow jumped 211 points, S&P advanced 0.28%, NASDAQ gained 0.4%. Now, I'm not calling the election here. That's not my department. I'm hesitant to spell out winners and losers until we get closer to the main event. But you're sticking your head in the sand if you think nothing's changed after the failed assassination attempt on the now official Republican nominee for president. The events in Butler, Pennsylvania, which were truly tragic, seem to have the world believing that those frightening moments have indeed cut in favor of a Trump win, and he was already leading in the polls. Since the Trump stocks are almost self-evident at this point, let's look at what the rally did today. Let's see if the stocks truly fit the bill. The most pronounced winners, the bank stocks, especially the big banks. JP Morgan up 2.5%. Goldman Sachs just reported a good number today, almost 2.6%, but both just doing very well. But let's call it as we see it. Wells Fargo, handicapped by regulators from the era of out-and-out chicanery, reported a suboptimal quarter last Friday. Stock got hit. But today it managed to rally more than 2%. Arguably, that's because CEO Charlie Scharf talked about how the economy is growing weaker and the loan business has gotten slower, something that will make it easier for the Fed Chair Jay Powell to cut interest rates, which would be good news for Wells Fargo at this point in the business cycle. I think the bank stocks have had two problems with the government that could be solved by the election of Donald J. Trump to the White House. First, the Biden administration acts as if all banks are guilty until proven innocent of pretty much everything. Whereas Trump, who created an empire on borrowed money, believes that banks are just plain innocent. In particular, JP Morgan and Goldman Sachs roared today because these two, plus Bank of America and Morgan Stanley, which report tomorrow, are heavily levered to both IPOs and mergers and acquisitions. The regulators are tough on IPOs these days, so the market's had a dearth of new deals. More important, these investment banks used to make a ton of money on mergers. Now, we know that both the FTC and the Justice Department's antitrust division have been extremely anti-takeover under Biden. His FTC chair has expressed great skepticism about how gains from most mergers don't go beyond shareholders. Regardless of where you come down politically, that position is obviously bad for the stock market, especially the investment banks. But Trump measures himself by the performance of the stock market, especially the Dow Jones Industrial Average. President Biden told me back in the day that the stock market means very little to him. He reveled in the fact that he didn't invest and took great pride in being the poorest man in the Senate. Legitimate position, but bad for the stock market. Now, we know that few things make the market go higher than tons of M&A activity, which is why I think a Trump FTC will look the other way on most deals, like it did last time, and the market could go higher on that disparity alone. Speaking of deals, right now the government is trying to block Kroger's acquisition of Albertsons because of grocery store concentration, even though they don't have all that much overlap once you spin off the ones that do kind of create a problem. You know what? I think Trump's people would say that we need a strong Kroger to compete against Walmart and Costco, which means the deal must go through. The current administration doesn't seem to care all about that. The government's also trying to stop Tapestry from buying Capri because it consolidates the apparel and accessory space. I bet the Trump people find that laughable. Second, the oil and gas market soared today on the hopes that there'd be less regulation and more drilling. I want to disagree with Wall Street here. The oil stocks did not thrive under Trump because there was too much drilling and therefore too much added oil supply. If you want to bet on a Trump win, I recommend buying the oil service companies only. I am partial to more domestic Halliburton because this is a domestic thesis. But I don't want to own oil producers because a Republican administration means more drilling, good for Hal, which means lower oil prices for all the stocks that soared today. People seem to believe that Trump would be more friendly to the health insurers than Biden. I'm not so sure that's the case. What matters here is that you're going to have a couple of quarters before we vote, including tomorrow's report from United Health Group. And these stocks are insanely volatile in election years. This one's way too dicey for me. However, the market's judgment about the drug stocks, very negative, very downbeat, is correct. Both Biden and Trump regard them as whipping boys. Very hostile rhetoric toward all of Big Pharma and most of the biotechs. There are plenty of stocks that you have to avoid at all if Trump wins, like anything related to saving the environment, because Trump says it doesn't need saving. Many alternative energy stocks have been red hot, but they cooled down today as the market started baking in a victory. For the investing club, we told people that you have to distinguish which stocks depend on subsidies and which don't. For instance, we defended Nextracker because they provide software that helps industrial solar perform more efficiently, not for people at home. But I get why Enphase, SolarEdge, Sunrun, and Sonova are down, because if the subsidies go away, those earnings, they will take a hit. Now, there's a belief that Trump will put on a 10% tariff on all imports. Hard to pass that in Congress. We know Trump will do his best to curtail immigration. That combination, has proven to coalesce negatively around Constellation Brands, which imports Modelo and Corona from Mexico. Tax on Mexican goods, declining growth rate of their core customers. I think that the argument's way too simplistic. We told Investing Club members to buy it today. And we will reiterate that stance strongly Wednesday when we have our monthly club meeting. Be sure to join and listen in, as many people tell me it's the best part of being a member of the CNBC Investing Club. Many people believe that electric cars will be hurt by the lack of a climate control initiative under Trump. Probably true. But this group shows you the difficulty of making sector judgments based on the president. Elon Musk wholeheartedly endorsed Trump this weekend. He said good things about his pick of J.D. Vance this afternoon. And that's one of the reasons why I think Tesla was up 2% today. It's a reminder of how fickle politics can be. Finally, we can tell from the rally in the Russell 2000, which has been ongoing now, that people believe small and medium-sized businesses will thrive under lighter regulation if we get a Trump administration. At the same time, Trump is viewed as a thorn in the side of big tech. I think the market's probably right on both counts. I removed the Trump stock button when Trump was done. But when I look back at the entire arc of the soundboard, I realize that it's hard to game out what a Trump presidency truly means for the market. He was never known for his consistency. Consider that one of the best investments the Charitable Trust ever made was in the knockdown stock of Amazon after Trump upbraided them for allegedly scamming the U.S. Post Office. The president was powerless to change things, and it's not clear that Amazon even took advantage of the Post Office to begin with. Instead, you simply got a gigantic buying opportunity in one of the greatest stocks of all time. Bottom line, after this weekend, it sure seems like the Trump stocks are back. Just keep in mind that plenty of companies are great enough to transcend politics, and sometimes what counts as a Trump stock can change on a dime. Let's go to Sam in Pennsylvania. Sam.
Jim, how are you doing? What?
Sam, speak to me.
Hello, Jim. Listen, hi. So listen, we got a great opportunity. We got a great opportunity in the market that only comes around once in a while. One of the great American brands out there, that's Nike. Recently, they had a bad quarter, but sales look good. The company is getting hurt by the market share being taken by On Running, which is something we warned about earlier this year when I was talking about On. But anyway, Nike at 73. Is it too cheap to pass up? Should we buy it at this what seems to be a 5-year low?
Look, I tell you, when I see senior growth on sale like this, it does make me think it's time to buy. I felt that way about Starbucks, which unfortunately my Charitable Trust owns. The problem is neither company has really owned up to what's wrong. Until we get truth and reconciliation about how poorly they're run or that something's got to change, you can't buy them. They just don't make sense. Let's go to Jeff in California, please. Jeff.
Hey, Jimmy Chill. I am on cloud 9 and over the moon. I've been dreaming about NVIDIA, and you told me and told everyone that you knew NVIDIA would do well. I'm up $138,000.
Wow. Wow. I am grateful for that. I saw a lot of people clog Wildlife Refuge this week where I ran an auction, and I heard many things similar. And I'm very proud of that call. But more importantly, I'm very thankful for the kind comments you just gave me.
Jimmy Chill, I am thankful for you, Mr. Wang. I just am dreaming about this thing. I'm loving it. Anyway, excellent. Jimmy, my stock is Vertiv. As soon as I bought it, it fell about $400. But the good news is, year to date, it's up 83.66%. Bam! And in 1 year, Jimmy, it's up 234.76%, which is incredible. According to Zacks, year-over-year cash flow, get this, cash flow is at about 88.4%.
Okay, I have to tell you, I think that Vertiv is very good, but it's resting. And when a stock is resting, we're not going to poke the bear. Let it just stay there a little bit, and then we can buy some more. But I do think it can go down a few just because it's been up so much. It's been such a remarkable stock. And thank you again for those gracious comments. In this election season, you have to keep in mind that plenty of companies are great enough to transcend politics. And sometimes what counts as a Trump stock, it can change on a dime. Mad Money tonight. There's a bull and bear debate happening in the analyst community when it comes to music streamer Spotify. So which take is music to my ears? I'm letting you know. Then you called in and you stumped me on ARDW metal packaging. I'm turning in my homework on this low dollar stock and see if I think that the 11% dividend could actually be a red flag. And later, I'm talking exclusively to the hottest stock in the S&P 500. We're going to the CEO of Supermicro, fresh off the news of the company's addition to the NASDAQ 100. So stay with Kramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Kramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Earnings season's officially underway, but things don't start getting real busy until next week and the week after. Right now, you could argue maybe we're in preview season where Wall Street analysts spend their time publishing notes about what they expect from virtually every company under the sun. And sometimes those analysts have very different views on the same stock. Take Spotify, the company behind the world's most popular audio streaming service, which reports next week. Now, we got a pretty bearish call on this one last Wednesday, followed by two bullish ones on Thursday. Oh, I love it when these contrasting analyst reports come out because they can help us distill the best of the bull and bear cases. Makes it easier for you to come to your own conclusion. First, let me give you some context here. After peaking in February of 2021, Spotify spent the bulk of the next 2 years getting just clobbered before bottoming in November of 2022 at $69. Since then, the stock has been moving steadily higher, climbing all the way to $302 today. Well, it's not quite back to its early 2021 highs, but you got to admit that's an incredible performer. Okay, now get this. Even as it's flattened out in the last few months, we have to figure out which is the right way to go. I am inclined, I'll tell you ahead of time, to like it, but I found some pretty interesting logic here. Let's go to our analyst gunfight starting on the bear case. This is an analyst at Redburn Atlantic, a boutique research firm. It downgraded the stock. This is what really got me. Not from buy to hold, but from hold to sell. Even as they raised the price target slightly from 210 to 230, which is still more than $70 below where they currently traded. Now, I was shocked. This is one of the most loved stocks in the whole world. Now, the negativity from Redburn Atlantic was actually part of a broader bearish call in the music streaming industry. I get that. They also downgraded Warner Music Group and reiterated a sell rating on Universal Music Group. Those two I totally agree with. As the Redburn Atlantic note says, matter-of-factly, right at the beginning, quote, music streaming is facing competitive and structural challenges that we argue will prevent broad-based price increases from becoming a new norm, end quote. That would be bad. Then the analysts go on to argue, quote, rapid adoption of music streaming services in developed markets has helped propel the major commercial music players to lofty multiples, end quote. That means they're too expensive. But as these markets reach saturation, the industry will need to rely on higher prices in order to keep generating growth. Redburn Atlantic argues that it's been insanely hard for anyone in the music industry to raise prices for decades now, and you know that. Just too many ways to get it for free. Long story short, these analysts believe that Spotify will find it harder and harder to generate subscriber growth and won't be able to push through much in the way of price increases. Kind of a judgment call. While Redburn Atlantic concedes that Spotify is an impressive operator with a very successful audiobook bundle strategy, they simply think that the stock's just too darn expensive given the likely slowdown in growth. As they see it, the company should put up 18% revenue growth this year. That's terrific. But they think it will decelerate to 6% by 2028. The analyst consensus is Spotify growing at 11% in 2028. So these guys are much more negative on the company's long-term prospects. Basically, they're arguing that the estimates are too high and the stock's too pricey. Now, you know, if they report something that is below what people are looking for, the stock will be crushed. So what about the more positive pieces on Spotify? Now, both these came last Thursday. It's a three-way analyst showdown. First, last Thursday morning, a new analyst over at Jefferies took over coverage of the same three music stocks that Redbird Atlantic had downgraded the day before. But Jefferies now has them a buy rating for all three after last week's upgrade of Spotify from hold to buy. They also raised the price target from $242 to $385. Now, that is an incredibly bullish call, as bullish as Redbird Atlantic is bearish. The funny thing is, Jefferies made basically the exact opposite argument, the opposite one from Redbird Atlantic. First, they say, quote, we are increasingly confident in Spot's ability, that's the symbol, Spot's ability to comfortably deliver sustainable 15% plus revenue growth over the next 3 years, end quote. That's the antithesis of Redbird Atlantic's projections. Even more strikingly, the Jefferies analyst goes on to say, quote, underscoring our confidence in 15% plus sustainable revenue growth, is our view that music is about to undergo a multi-year repricing. At just $12 a month for Spotify subscription versus $61 a month spent in aggregate on video streaming, we believe there is room for price increases at least every other year, end quote. And if Spotify can put through a couple of price increases, they believe the company could triple its operating income over the next 3 years. What makes Jefferies so confident in Spotify's pricing power? Simple. Spotify really hasn't had many price increases to date. In fact, note that the company had 0 price increases for its main U.S. monthly subscription offering until last year, when they hiked the price from $9.99 per month to $10.99 per month. By contrast, Netflix has raised prices by 41% since 2018, as have other popular subscription services like the dating app Tinder. Just kind of a compare. Even if the bears at Redbird Atlantic are right that there's a ceiling for how high these music streaming services can raise their prices, even if it doesn't come close to what people will pay for video streaming, I think Jefferies is right that Spotify's still got a long way to go before they get close to that ceiling. Now, the last piece of the puzzle came last Thursday evening when analysts at another boutique firm, this time Wolf Research, initiated coverage of Spotify with a buy and outperform rating, $390 price target. The Wolf analyst points out that Spotify dominates this industry, 1/3 of the music streaming market, more than double the size of its closest rivals. Compared to the music labels, they argue that the company, quote, provides pure play exposure to evergreen music streaming without hit-driven variability, artist negotiation risk, and boasts minimal capital investment intensity, end quote. In other words, it's not comparable to record labels at all, which was a big part of the bear thesis from Redbird Atlantic. Boy, I really agree with that. Furthermore, the Wolf analysts stressed that Spotify is not just about music. They also have high-growth initiatives in podcasting. I know a lot of people listen to that, audio books, which we listen to, and live events, all of which have access to the company's huge built-in network of 615 million monthly active users worldwide. That's an incredible number. Hey, by the way, only about 1/3 of those have subscriptions. Over time, Wolf Research believes Spotify can layer on additional services with small incremental price increases for those who want them. Very compelling argument. At the end of the day, boy, I got to tell you, I am inclined to side with the bulls on this one. I want to give let's give the bearish Redbird analysts some credit for highlighting risks to the music industry as a whole. But I think they fail to appreciate that Spotify is the key cog at the center of the industry right now. The bears seem too afraid of the competitive threats from Apple, Amazon, and YouTube. Hey, they're legitimate competitors that have nevertheless lagged far behind the big dog for many years now. Given Spotify's colossal scale in music streaming, this is the last player in the industry you should be worried about. They have more pricing power than any of their rivals. Plus, as the bulls at Jefferies noted, the fact that Spotify hadn't raised prices at all through their first 15 years, means they now have a lot of room to play catch-up. So the bottom line here in this analyst shootout, as I see it, Spotify's not hostage to the broader music streaming industry. They've built an unassailable leadership position over the past decade and a half, which gives them more pricing power than anyone else in the group, even as they've largely chosen not to use it. But if they need to, they can, which is why I think this stock remains a buy. I really like it. Mad Money's back after the break.
Coming up, don't kick the can, do your homework today. Kramer tests his mettle with a can-do attitude. Next.
Every night we take calls from our brilliant audience, and when I'm stumped with a stock I don't know about, I always promise to do some homework, and then I circle back later. Which brings me to ARDW Metal Packaging, which Perry, a veteran from Louisiana, asked about over a month ago. Not only did I not recognize this one, but Perry asked a very specific question, after giving us perhaps the most hilarious booyah in many a year.
First of all, I want to tell you thank you for everything that you've done for me as a retired soldier, and I want to give you one big New Orleans who dat,
Holy cow.
booyah.
Oh, my God. Well, that is just massive and just made my whole weekend. I'm going to actually live on that for the next 8 days. And that's exactly what happened. I did. Anyway, Perry in Louisiana wanted to know if the dividend was safe or, of course, whether it was dangerous. That's not the kind of question you want to be off the cuff, right? I mean, especially with the stock that supports a potentially dangerous 10.8% yield, not to mention a $3 and change share price. Come on, stocks of well-run companies almost never visit the single-digit area. Everything down there is either a mess or it's something very speculative, meaning inherently high risk. At its core, ARDW Metal Packaging is actually a simple business. They make cans for beverages, beer cans, soda cans, whatever. Simple enough. But here's where it gets complicated. This particular can-making business was established in 2016 when a larger European packaging company, ARDW Group SA, acquired the can business that was spun off by Ball Corporation and Rexam in order to get approval for the merger. Then ARDW Group came public in 2017 with the ticker ARD. And for what it's worth, this was not a particularly great stock for the 4 years that it traded on its own. Get this. The story changed in February 2021, though, when ARDW Group decided to spin off its metal packaging division and merge it with a special purpose acquisition corp, or a SPAC, called Gores Holding 5. The old ARDW Group retained an 80% ownership stake in the new ARDW Metal Packaging, so they still essentially own the business. They also got more than $3 billion in cash for the transaction. There's a lot more complications in this SPAC deal, but long story short, the old ARDW delisted in September of 2021, right after ARDW Metal Packaging started trading on its own. Goodbye, ARD. Hello, AMBP. Think about the timing here. The SPAC deal was announced in February of 2021, almost exactly the height of the SPAC mania, and by the time the deal closed that August, SPACs were already well out of favor. After the deal closed, ARDW Metal Packaging saw a brief pop, reaching a high of $12 and change. Hey, but after that, the stock started sliding lower. Sell. And it didn't stop going lower until last October, when the shares finally bottomed at $2 and change in October 2023. That's down almost 80% from their peak. Since then, this thing's been range-bound between $3 and $4 for the bulk of the past 9 months. So that's the complicated corporate history of ARDW Metal Packaging. But now let's talk about the fundamentals. This is a leading supplier of what's known as infinitely recyclable metal beverage cans. And they work with tons of major players in the industry, with 42% of the business coming from Europe and 58% coming from the Americas. Given the stock's abysmal performance over the past few years, you won't be surprised to hear that the numbers have been deteriorating. The business had a nice 18% revenue growth in 2021. That was the year that the SPAC merger took place, in large part due to COVID-era supply shortages. But in 2022, while sales grew a solid 16%, their earnings for interest, taxes, depreciation, and amortization fell by 6%. Last year's sales grew only 3%, and EBITDA fell another 4%. Now, when you look at the less forgiving GAAP earnings, as the traditional way you measure things, ARDW Metal Packaging lost money in 2021 and 2023. Now, if you look at the 2024 consensus estimates, they're a bit better than they've been. The analysts are looking for 3.6% revenue growth, 9% EBITDA growth. Management's own guidance calls for mid-single-digit % shipment growth. When they reported in April, the results were technically mixed. But ARDW reiterated its full-year forecast and issued better-than-expected EBITDA guidance for the second quarter, which briefly allowed the stock to rally. Hey, by the way, the company reports again next Thursday, and you know what? I have absolutely no idea how the quarter will be. So, in terms of the fundamentals, I could make an argument for ARDW Metal Packaging. Sure, the business hasn't been great in recent years, but it finally seems to be stabilizing, if not improving this year. Plus, the can industry is basically an oligopoly, which makes it easier for the few existing players to hold on, even in tough times. Valuation-wise, this one seems fine. The company has an enterprise multiple that's basically in line with Crown Holdings, that's a rival, and a few turns lower than Ball Corp, the other major player here. But remember, I had a specific assignment from Perry in Louisiana. He wanted to know if ARDW Metal Packaging's dividend is safe. And this is where I start to get a little squeamish. The double-digit yield was already a red flag. And when you start to look closely at the company's balance sheet, well, you will not like what you see. The company had just under $4 billion in total debt at the end of the first quarter, and with a market cap of just over $2 billion currently, that means its debt-to-equity ratio is close to 2. Now, Ball Corp has a debt-to-equity ratio of 0.3. Crown Holdings only at 0.8. Now, to put things more simply, ARDW Metal Packaging has roughly 598 million shares outstanding, so the company's 10-cent per share quarterly dividend costs them just under $240 million per year. Problem is, the company only is on track to generate $117 million in free cash flow this year, according to FactSet. Next year, that's expected to grow, but only to $185 million. Still not nearly enough to cover the payout, what they pay in the dividend. When that happens, the company has to borrow money to cover the gap, worsening the already suboptimal balance sheet situation, or they have to do the easy thing, and they have to cut the dividend. Now, to be clear, I'm not necessarily predicting this company will cut the dividend anytime soon, especially because they just reached a deal for a new credit facility with Apollo, the private equity giant, in April, in order to pay off a big loan that's coming due next year. But oh boy, man, my rule of thumb on dividend safety is simple. If your free cash flow can't cover the payout twice over, you don't have a truly safe dividend. ARDW can't even cover it once over. In the end, this company has a long-term balance sheet problem that needs to be sorted out. Bottom line, I was intrigued by this new can maker option because I love investing in industries that are effectively oligopolies. But the earnings trajectory over the past few years is not inspiring. And while that nearly 11% dividend yield sure seems tempting, I don't feel comfortable enough with the balance sheet or the cash flow to call it safe, which is what Perry specifically asked about. So that's why I can't bless ARDW stock as a good pick for an investor looking for yield, like Perry from Louisiana. Let's go to Steve in Nevada. Steve.
Hey, Jim, thanks for taking my call. I had a question for you about my 3M stock I purchased on the dip about 3-4 months ago and has now become 3M Solventum, as you know.
Right.
And I bought it mainly for the dividend, and the Solventum keeps going down, and they just slashed the dividend on the 3M. What can we expect from this new CEO? Is he going to...
I think he's doing what's necessary. I know Bill Brown from his previous employ, L3 Harris. He was fantastic. I think Mike Roman did a great job cleaning up the real issues that were impacting 3M. I think 3M is a buy. Let's go to Cindy in New York, please. Cindy.
Hi, Mr. Kramer. So nice speaking to you. I'd like to know your opinion about Starbucks. I mean, it was doing very well. Now it's really going down south.
It has been.
Or should I buy?
Well, I did a very big piece of, understood. I did a very big piece this weekend, which talked about Chinese stocks, companies that have a lot of business in China, and what a disaster they are. And that we should start forcing managements to recognize that it's no longer great to be in China. This stock is down 24% year to date. I'm not happy with it. I own it for the Charitable Trust. I wish I did not. I was saying that there's going to be a level where all the bad news is in, but it has to come with some recognition that China is no place to invest. We certainly don't expand there. Even though I like the company story, I don't feel comfortable enough with ARDW's balance sheet to call it safe. I say kick the can a little further down the road on this one. There are better places to put your money right now. Much more Mad Money ahead, including my Super Microcomputer. Could its addition to the NASDAQ 100 be a needle mover for the already red-hot stock? I'm getting the latest from the CEO. Ben, I think we are in need of some optimism here and there and everywhere. So I'm digging into the BlackRock CEO Larry Fink's comments when he told me this morning that has me feeling a little more sanguine about the state of capitalism in our country. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Kramer. After the close last Friday, we got the great news that Super Microcomputer, the maker of advanced server storage solutions and tech components, many of which power artificial intelligence, will be joining the NASDAQ 100 next week, replacing the moribund Walgreens. Now, this stock has had an incredible run, rallying nearly 250% last year and tripling again this year, best performer in the S&P 500 so far. Though it's been trading sideways for months now after pulling back from its March highs. So could this thing be rested and ready for its next move? Let's check in with Charles Liang. He's the founder, chairman, CEO of Supermicro Computer to get a better read of the situation. Mr. Liang, welcome back to Mad Money. Congratulations.
Thank you, Jim. Nice to meet you.
Now, what do you think this inclusion to the NASDAQ 100 means for your company after joining with the S&P 500 earlier this year? And what does it say about the accomplishments that you've had?
Oh, it's a great honor. You know, we are really excited to be one of the NASDAQ top 100 company. It's also showed a recognition from the industry about our liquid cooling, our green computing, our best AI platform to service the world. And we are continuing improving our product, and hopefully this year we can move DLC, liquid cooling, to 15 to even 25% of global new data center deployment for AI.
Now, I think it's important for people to understand the growth you have is so great that you sometimes have to outstrip necessarily your profits in order to keep growing. Something that I totally support because most companies don't have growth like you. What does it mean to you as a CEO to manage cash at a time when you have super hyper growth?
Oh, it's a great experience, you know. Liquid cooling, green computing, that help customers save energy costs, reduce carbon footprint. At the same time, because that's power required to power a data center. That's why it's also enable customers to build their data center, go for online much earlier, much quicker than otherwise if they go for traditional air cooling solution.
Now, I want people to
save money.
Go ahead. I'm sorry, sir.
Save money, reduce carbon footprint, and enable their data center online quicker than otherwise go for traditional air cooling.
Of course. Now, I want people to understand the difference between your method of cooling, and I think the best way is to talk about how many trees you have saved because of your cooling.
You know, from our calculation, detailed calculation, if global data center go to liquid cooling, green computing solution, together we can easier to preserve 20 billion trees for our planet, save money, grow tree, preserve tree for our planet, and enable data center time to market. So it's a great honor and really an exciting experience here.
So 8 billion trees saved, 30 fossil fuel power plant reduction, so important at a time of global warming.
Yes, I mean, it's an amazing advantage. Since 20 years ago, when we started green computing, indeed, we did not believe the impact will be so big. But year after year, accumulate the technology, better technology. Now, this is the contribution we can help the industry.
Now, Charles, what does that orientation have you stand with Jensen Huang at NVIDIA, given what a huge environmentalist he is and trying to keep the heat down at his data centers?
He is a great leader. You know, when I talk to him, really appreciate his talent. He is one of the genius. So it's very good experience to work with him. And he always bring a challenge to customer partner like us. But it's a great challenge. We together do a good thing for the industry and for our planet. So have been a very exciting, happy experience.
All right, so Charles, I was with a former partner of Goldman Sachs this weekend, and he said, we were going back and forth, and he said, you know, Jim, this AI spend can't continue at this pace. And I said, yes, it could actually accelerate from this level. Where do you see artificial intelligence spending in the next 3 to 5 years?
Oh, I personally believe this AI revolution can be bigger even than the industrial revolution, because all the people like the convenience, the smart tool, the fancy feature that AI offer to our people. So I believe it will continue to improve. And the good thing is, with NVIDIA good technology and with our energy saving solution, we can help customers increase not much power, but continue to offer much more powerful AI solution to the world.
Now, in order to meet the expansion issues, should you be raising capital, maybe another convertible bond? Would you think about doing another equity offering to be sure your balance sheet stays strong?
You know, last 2 years, we have been growing a lot, more than double last year, for example. And we believe we will continue to grow at a very fast pace. So I believe we may need some more capital to support our quick growth. The good thing is, the more system we provide to the world, ship to customer, the more money we save for customer. And the greener the data center we help the industry. So I'm personally very excited and will continue to speed up our progress to help the industry.
All right, well, we call that the virtuous circle. Supermicro has it, and I just am so thrilled that you came on Mad Money. Charles Liang is the founder, chairman, president, CEO of Supermicro Computer, the #1 stock in the S&P 500. Thank you, Charles. Good to see you.
Thank you, Jim.
Absolutely.
Thank you.
Absolutely. Mad Money's back after the break.
Coming up, pop open those umbrellas and tee up your toughest questions. Kramer takes on all comers in the lightning round. Next.
It is time. It's time for the lightning round. Chris, it's Ralph. You say the name of stock. I tell you bye. So it's been joining your call. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Let's start with Philip in North Carolina. Philip.
Jim, first things first. How are you doing today?
Excellent day. Thank you. How about you?
I've been seeing down south here, fair to Midland. Fair to Midland, Jim.
Fair to Midland? All right.
Yeah, that's a thing they say down here in the south. Anyway.
I got you.
Okay. So this stock I own for about 3 months. Okay, I'm up 80 about 80 points on it. All right. Now it's a very small part of my portfolio, and I want to do against what you preach, and that's the bulls make money. That thing. I want to keep all 70 shares that I have.
Okay.
That's how good I think about this stock.
What stock is it?
Oh, I didn't tell you. Oh, I'm sorry. Amen.
Oh, Barista Network. You know what? Go for it. Jay Sridulal is an amazing business person, and I think it's a fantastic stock. I'm not going to get in the way of you making a lot of money, and that is more than a fair to Midland stock. That's a great one. Barry in Florida. Barry.
Hey, Jim. Barry down here in Miami. Booyah. First
hey, good to have you on the show.
Long time.
All right. Glad to have you. What's happening?
Jim, here's what I got. Another Barry, much smarter than me, steers the ship from Starwood Properties. I love that guy and the stock. But with the headwinds in the commercial real estate, especially the office market, can he hold that almost 10% dividend?
Well, I think he can, but here's my problem with the stock. He has scared me out of recommending his stock. He came on, he said there'll be a bank that might fail every single week, and after that I said I can't recommend his stock. So, I mean, he has to be a little bit more upbeat for me to think that his stock is worth buying. He talked me out of his own darn stock. Let's go to Mike in Michigan. Mike.
Mike, Jim. How are you?
Excellent. I am doing well. How about you?
I am living the dream, man.
Excellent.
Hey, I need your help on a value stock that I bought earlier this year, believing it would benefit from infrastructure investment and autonomous agriculture. Unfortunately, the company sales dropped 15% last quarter, and it's working off excess inventory. John Deere is trading at near a historical level from a PE multiple standpoint. Should I continue to run with the Deere, or should I keep greener?
I don't want you to sell it down here, but I have to tell you, we have struggled mightily with trying to figure out the upside. Ben Stone and I the research director, spent a huge amount of time on it and just feel like, you know what? It's very tough to justify owning the stock. Let's go to Bill in New York. Bill.
Good evening, Mr. Kramer. Thank you for taking my call.
Of course.
My question is regarding NEO. I have a pretty large stake, and I'm in it a little under the high. I'm wondering if I should cut my losses on this stock or hold. And if so, what's a good exit?
NEO's one of those stocks where if you sell it right here, some clown will come out and be real positive about it. There'll be some plenary nonsense. It'll go to 6 and you'll hate me. So let's just wait till all that stuff happens, and then you can sell it. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Kramer changes the tone with a little help from an old friend. Next.
If you're at all like me, you have an incredible need for some optimism right now. It's not just the political violence this past weekend that makes things feel dark, makes things feel grim. This whole election year has been a mess. Something that seems very much in sync with the tone of the country. But today I heard a different tone, a tone that made me feel that the end of the world is not on the table, and it comes from someone who'd know, someone whom I have tremendous respect for, not just as the chairman and CEO of BlackRock, the world's largest investment manager, but as the guy who may have the greatest knowledge base of anyone on Wall Street, and that's Larry Fink. Listen to what he had to say today about our markets.
We have the most dynamic capitalistic system in the world. We have great companies. We have great ingenuity, great technology. Let it unbound, let it go, create great jobs, create opportunities, and we'll have a rising equity market that will really fuel this opportunity.
What a breath of fresh air. Fink's an optimist. He recognizes that we must encourage growth because without growth, our government will be overwhelmed by its debts. Business needs to be more unfettered, less regulated in order to generate that growth. When you look at the trillions of dollars in debt, he says we cannot tax our way out of this burden. The deficit is a huge lurking problem, but we can grow our way out of it, maybe with companies using the wonders of AI, interrogating the data, and making themselves more productive. Larry came to Squawk on the Street on a very good day because at this moment of intense political division, we need a neutral, calm voice who can explain how capitalism is a force for good, a force for wealth generation, not just for the rich, but for everybody as long as they invest. He believes in something that's in incredibly short supply. He believes in hope. Listen to what he said about Saturday's events.
And what happened this weekend is a tragedy. It is a statement of America today, though. We need to create hope. All of us have a responsibility. Every political candidate, every leader, every pastor, minister, rabbi, we all have a responsibility of bringing our community together to bring hope. And that's what we are here for, to bring hope.
As tough as it might be, I think you can't invest successfully without a certain level of hope. If you don't have some hope, then you'll be shaken out of potentially great investments by passing fears. As someone who runs a portfolio connected to a charitable trust, I'd like for you to own some individual stocks, and that's the craft we teach in the Investing Club. But I don't care what you invest in, as long as you invest. Heck, Larry said today that he now favors investing in Bitcoin, perhaps as a way to hedge against deficit. I get that too. No matter what happened this weekend, no matter what happens in November, you must have some faith in capitalism to help grow your wealth. That's why I salute BlackRock and I salute Larry Fink for thinking bigger than just the quarter. He's thinking about giving you some excellent options to try to help you make a lot of money. But if you don't have hope, if you don't believe at least a little bit, then it just won't matter. I like to say there's always a bull market somewhere. I promise to try to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and/or subsidiaries warrant report, its completeness, or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.